What is up? This is the Working Investor. In this video, we're going to talk about my questions that I had for William Ryan from GraniteShares that also has the YieldBoost suite. And I try to be very polite in my presentation of my question, first complimenting him of the uniqueness of the fund, but then really want to get down to the crux of my question of why the total returns utterly suck. As always, nothing here is financial, tax, legal advice, or hamster race advice. This is purely for fun and entertainment purposes only. And why I truly believe that a lot of people who invest in this fund may not understand what is called total return. They may not understand, unfortunately, the difference between what is called revenue in a business and the difference between revenue and net profit. And the dividends that people receive are, when the NAV is eroding to such a significant effect, the actual money you get is what you have left over in the bucket. And a lot of people try to reinvest, but it seems like a never-ending chore and cycle, because of the rat race. You're so used to the rat race, unfortunately, from work that you're kind of trying to use that kind of strategy in investing. And why would you want to use the rat race approach in investing? Now, I made a whole video that goes into detail of the strategy of his fund, the strengths and weaknesses of his YieldBoost funds. I'll put a link to my video. In summary, I think it is paramount for people who invest in these funds not to just be dumb and look at money. They should actually understand the strategy that they deploy. Know what you invest in. Educate yourself on what you're investing in. So this is a put credit spread strategy with no long position. That means they don't have any exposure to the actual assets. And basically your risk is the width of the spread. So as long as the stock doesn't go down to the point where it breaches your spread, you should be collecting dividends and you should see your NAV stable. Sometimes you may see your NAV go up, but that could be representing of the income that they've received that haven't paid out. And then when they pay it out, your NAV would go down to the probably pre-income collection portion. But for the NAV to truly fall, it has to blow. What I understand is it should blow through the spread in order for that to happen. The problem is that when it blows through the spread, and eventually the stock bounces back up and it goes up 50, 60, 70%, you don't capture any of the upside. Forget about don't say capped upside. There is no this is not a cover call strategy. This is a put spread strategy with no long position. There is, listen carefully, zero upside. Zero upside. If the market goes up, the only thing that's going to happen is you're going to collect those income from the spread, but it's not going to be reflective of the upside unless they have long position. And they do this on 2x and 3x products. And what do you think is going to happen? How often it's going to blow through the spread on the 2x and 3x products? I literally presented him with data in this chart, and I showed him the dismal total return, which uncovers the actual performance of the underlier. And you could see year to date, and again, this fund came out the 18th, I think it's the 17th, and launched on the 18th, or trade on the 18th of December. So year to date is close enough. And you could see that TSYY is down, total return 11.86%. So a nincompoop investor who thinks, oh, I'll just reinvest the dividends. Well, you'll have to reinvest all the dividends. And even reinvesting all the dividends from inception, you're still negative 11.86%. So that's not even enough to break even. Like, are you trying to struggle just to not even break even? I thought the purpose of investing is actually making money, not losing money. But you can argue and say it was a bad timing because that's probably when Tesla came down. So if you go on the 6-month chart, you could see everything did a little better. And yes, I'll admit that you could see right here on the numbers don't, the math doesn't lie. TSYY has a positive total return on the 6-month chart, ignoring the first part of the year, of 32.49%. But if you look at relative to other assets that are exposed, that are based off of Tesla, you could see the cover call strategy has done far, far better, almost pretty much twice as good as this strategy in a good market. This fund, this GraniteShare YieldBoost fund, actually makes YieldMax and Curve look really good. They make them look good because the bar becomes so low with these funds. This 32.49%, that's not reflective of the stock price. That's reflective that they probably didn't blow through the strikes because the stock was moving up. So that's probably just the income because there is no growth. At least you see what a difference it is when you have growth as well, even a little bit of capped upside growth. Not financial advice. And of course, relative to the underlier of Tesla, it's 82%. I understand that TSYY does the spreads on TSLL, but everything boils down to what behavior Tesla is doing. So I was going year to date presenting this data, and he was telling me that I don't know if it's a reputable site. I think you're maybe cherry picking the dates, but this thing came out from inception. I'll even go back to inception. Let me show you. So you go on Seeking Alpha, go to the 1-year chart, press on the stock. You see it says 12/18/2024. So let's make everything fair. You can see right here, 12/18/2024, apply. Let's go over here. You could see TSYY, bottom of the pack, negative 12%. Tesla is, almost, it's 19 basis points negative. Tesla is positive 1.44 and TSLP is positive 3.43%. And this is the furthest amount of time that I can capture since TSYY has been trading in the market, according to Seeking Alpha. It's a dismal total return. But if we go back to the year to date, I was accused that maybe this is not a good website and there's problems. But let's compare year to date to stock analysis. Now look very carefully. TSYY negative 11.86%. On stock analysis, it's negative 11.9%. So it's off by 4 basis. There's a discrepancy of 4 basis points between these two. Let's look at Tesla, on stock analysis, positive 9.8%. And per Seeking Alpha, instead of 9.8%, it's 9.44%. So it's off by 36 basis points. So there are some little nuanced discrepancies between different sites, but when you're looking at multiple different resources and they're giving you kind of the same data, like why doesn't he just say, hey, listen, you do have a point. Maybe there is a problem with our strategy. Maybe we're going to try to fix that problem and we're working on that. I would definitely respect that. But just to say, oh, I think you're cherry picking, or I think I don't know if it's a reputable site or there's problems with these sites, it's janky. Come on. Like, did you look at the data yourself? Okay, what site, I challenge you, pick any site you like, that's reputable, and you'll probably get somewhere in this data, I would suppose. Anyways, yeah, listen, everybody has a right to do what they want. Some people think that buying lottery tickets is an investment because you can make it big. I mean, listen, who am I to say what people do with their money? Everybody has a right to invest whatever risk tolerance they want, and it's up to them. Just because I disagree doesn't, I don't like to invest in something doesn't mean that there is a use case that some people have. Anyways, this is the Working Investor over and out. I hope you guys have a wonderful trading week. Be well.